Hi, this is DrMNP. Welcome back to my show after a 3-week break. So in those 3 weeks, lots of things have happened in the market. So let's talk about that. So let's start with sharing the charts I have made. Okay, so here's the charts I'm sharing. And you can all see that now. Okay, so today is the February 26th. And as usual, I need to show you my disclaimer, which tells you that the final decisions you make on the investments are your own. And the presentation I show you here and the ideas I give you are for informational purposes. Okay. All right. So what happened in the market for the last 3 weeks? The market had a rough time because two key things happened. The CPI report, the Consumer Price Index, which is a measure of inflation, and also the PCE data, which is another measure or an index of inflation, they both were worse than anticipated. So the market did not like that. So the last 3 weeks, the market went down a lot. It started around 4,118, the S&P 500, and ended up at 3,970, which is quite a drop. And why? Because if the inflation is not coming under control, the Federal Reserve Bank will have to raise the interest rate further, a lot more than the market was expecting. So that's not good for the earnings, etc. Okay, so the market went down. In addition to that, some of the Fed officials came up and gave very hawkish comments, and the market was not happy with that either, and the bond rates kept going up. So all these factors, put a lot of pressure on the market, and the market came down. So what do we do now? So does it mean it is a good time to buy stocks or trade stocks? So my opinion is, and my forecast is, over the next 4 to 6 months, the market will be under pressure. The interest rates will keep going up, but the inflation may not come as fast as the people would like it to go down. And also the earnings that will be coming out in April, May time, which will be the first quarter 2023 earnings, is going to disappoint people. So that will, put a lot of pressure on the market. And so the market might retest the lows we had before, which was around 35 plus, 3,500 plus in S&P 500 in October last year. So the model I had is forecasting, a low that could be as low as 3,200. So there'll be plenty of buying opportunities in the next 4 months. So you have to be a little bit careful. However, the market doesn't go down in straight line. So it'll go up and down. So in that period, there'll be a trading zone wherein you can do covered options, covered puts or covered, calls. So that's one thing you can do. However, right now, there may be some buying opportunities in healthcare stocks because they're seen as defensive stocks. And, people, will start buying those stocks. And, so that may be a good place to start with. All right. So what am I going to do now? I'm going to discuss 3 sectors. So I'm going to use a different format. So I'm going to make the presentation a little bit shorter so that I don't have to go through all the model I do or the analysis I do, but just tell you what the output of the analysis is and give you some ideas in 3 sectors. We'll look at 3 sectors today. We'll look at healthcare, we'll look at industrials, and we'll look at consumer discretionary sectors. So the next time I'll look at the other sectors. So in each sector, I will select 6 stocks. I have selected 6 stocks wherein, there are lots of good things about these 6 stocks, and I'll talk about them, okay? So here is the healthcare sector. So the healthcare sector, has, 6 stocks are selected, and it has lots of types of healthcare stocks. So these stocks are also kind of diverse set of stocks within the sector. So AbbVie is a pharmaceutical company, that is AbbVie, and AbbVie is well known for Humira. You probably have seen the ads on TV about Humira, right? And that one, they had a long run up on that drug. They made billions of dollars, in revenues and billions of dollars in profit. And this year, the patent went away, which means others can create biosimilar, they call it, which are very similar to what AbbVie is doing with Humira, but may not be an exact replica, right? So people are worried that the major source for their revenue and earnings will start going down, and it will. But how fast will it go down is the question, right? So what AbbVie has done is they have been doing research and development on other sets of drugs, and they have few drugs which have started taking off. And in the recent earnings announcement, they kind of told the market, look, you guys don't have to worry that much. These new drugs will compensate for whatever we are losing in Humira, especially within the next 2 years or so. So the AbbVie stock has kind of found shall I say, a bottom. In other words, it will not go down that much over the next few months when the market is in trouble, right? So this stock, if you look at the bottom line here, the bottom row here, shows you that the range has been 134 to 175 in the last 52 weeks. So right now it is 152. It is not too far from the bottom. So the model is saying the buy zone for this stock is 145. The other good thing about AbbVie is a dividend paying stock. They pay a very good dividend, 5.92, which is almost like 4%. And even better about that is they keep increasing the dividend every year, almost 10% a year. So that's a good stock to buy. And the buy zone is 145. So you're not too far from the buy zone. So the moment it starts going below that, when there are bad days in the market, go and pick up some stocks. If you're, as I already tell you, if you're thinking of buying 100 stocks, do it in 4 trades or something like that once it starts going below 145. The second stock is Abbott Laboratory, which does medical devices. They also do, the other healthcare products like baby foods. They were in news. They had some problems with supply chain, and but I think they have settled most of that. And this stock is right now around 100, which is pretty low, in terms of historical measures. And over the 52-week, they were 93 to 124. So they're not too far from the 52-week low, which was 93. So when this stock goes below 95, it enters the buy zone. So you can start buying it at that time. And they also pay a decent dividend, $2, but they also increase the dividend every year, pretty good. So that's a good, both AbbVie and ABT are good growth stocks, as well as a dividend growing stocks. You should buy that, in that buy zone. The next one is the Danaher, DHR. Right now it is 248, and their range has been 233 to 303. And we discussed this stock in detail a few weeks ago. And we know the buy zone for that is less than 240. And you're not too far from that. And they have a smaller dividend, but they do grow the dividend very well. So that's another stock you should have in your healthcare portfolio. And the fourth stock I have for you is CVS. You all know CVS is a big drugstore chain. They also have Aetna, which is the medical insurance company, and they also have this Minute Clinic, which provides clinical things for patients, and they pay a good dividend too. And their 52-week range has been 84 to 109. So right now it's less than 86, which is a buy zone. So this is a stock you can start accumulating right now. And the fifth one I have for you is the United Healthcare, which is a large, medical insurance company. They're around 484, and their range has been 436 to 558. And we discussed this stock as well in details. And the time you start accumulating this stock is when it goes below 450. Now with UNH, there are some regulatory things you need to worry about, what the Congress will do, that type of thing. So keep an eye on that part also. They pay very good dividend, $6.6, and they keep growing that very well. So all these stocks are good dividend growing stocks. The final one I have is ZTS, Zoetis, which is a healthcare company, not for people, but for pets. And that's a very big market, and it's a growing market. And their range has been 124 to 201 over the last 1 year. They pay a decent, dividend, not very high, but not bad. But again, their dividend keeps growing very well. So that one, I think we discussed this stock also, a couple of months ago in detail, and they went very low, and that was a very good point for entry. And I think I told you that. And now they have come back because they had a fairly decent earnings last quarter. So the you may never hit that low again, but anytime it goes below 150, start accumulating it. So healthcare is a big sector, right? Within the S&P 500, 15% of the stocks are in that sector, 15% by market cap. Okay, so these are very good 6 stocks in that sector, and there's a little bit of diversification also within the sector. So you can keep this as your shopping list and keep watching the buy zone, right? And then start accumulating. Okay, so that's the healthcare sector. So in the next sector, we will talk about, industrial sector. Okay, so you can see there are again 6 stocks I've chosen for you, and they're all good stocks, either large cap or mid cap stocks. And I've done some diversification here also. Honeywell is the first one, which is an aerospace and control, industrial control, and even residential control company. And then the next one is the LMT, Lockheed Martin. They make fighter jets for the Air Force. And then Rockwell International, ROK, which is an automation company, which caters to commercial industries. And with all the labor problems we're having, and with all the automation that manufacturers are doing, Rockwell is a good stock to own. And then RTX is a Raytheon, which is again a defense company, and and in this country the defense budget always keeps going up. Don't ask me why. So these defense industry companies are also doing well. UNP is a railroad company. So that company is the stock is right now depressed because of the recession fear, but that's a good stock to own. And lastly, the UPS. You all know UPS. That again is in the transportation, but different from the railroad. And they're also a very good company, but they're also under pressure right now because of the economic slowdown that is coming. Okay, so let's look at each stock one by one. Honeywell on Friday closed at 192, and their 52-week range has been 166 to 220. And when I modeled it, the buy zone for this stock is less than 180, so it's not too far from the buy zone. And once it goes below 180, start buying it. They pay a good dividend, and they also raise the dividend every year. They have a very good record. And the next one is LMT. So right now it's at 480, and the range was 373 to 498. So they are very close to actually the high, but during the budget negotiations, there might be some talk of limiting military spending, etc. So this stock might be under pressure. So if it goes below 430, you should take that. It's a very good dividend stock. The dividend is very high, $12, and they keep raising that every year. The next one is Rockwell. So that's also very close to the high, 290 right now. And they had a bad quarter 2 quarters ago, and they hit pretty low 190 at the time. That was the right time to buy. So they are kind of coming out of that problem they had, And people have realized that this is a very good stock for the future in terms of all the onshoring that is going on, all the manufacturing that is coming into this country. And so when it goes below 260, that's a buy zone and you should be buying it. They also pay pretty good dividend and they keep raising the dividend very well. Okay. The Raytheon, the another military stock is right now 99, and they're very similar to LMT, but in a different sector within the military products. And they had a 80 to 108 range. And when they come to 90 in the model, that's where you enter the buy zone. You should start buying that. And they also, actually, they are a combination of two previous companies. One was Raytheon, which was purely a military company, and United Technologies, which also has products for commercial industry. So they're pretty diversified as well. And they pay a decent dividend, $2.2, and they have been increasing it every year. So when they go below 90, you should buy that. Like you should start accumulating that. UNP, is right now is 194, far away from their 52-week high, which was 278, very close to their low, 183. I think they will retest that low. They will go to that low, in the next 2 or 3 months. And when it goes below 185, start accumulating that and start buying that. And that stock also pays very good dividend, $5.2, and they keep increasing it. And finally, the UPS, and it's kind of at the midpoint between the range 154 to 223. So on Friday, it was 180. And they will go down because of the economic weakness that's coming. So when it reaches less than 165, it will start going towards 154, retesting the low, and at that time start accumulating. So 5 industrial stocks, pretty good diversification, some aerospace stocks, some control industry, some military industry, and automation industry and transportation industry. So there's a pretty good diversification within the sector. This sector is around 9%, slightly less than 9% in the S&P 500. And I would target 9% for the portfolio, okay, for your portfolio. So that's the recommendation for this sector. So finally, we have the consumer discretionary sector. So this sector, I think over the 3 months, will have a lot of problems because right now the consumer spending is holding up, but over the next 4 months, it'll go down like crazy because consumers have started running out of their savings. They're taking more credit card debts and things like that. They're all indicators telling you that in the next 4 or 5 months, the spending will go down. And these companies, which are very much tied to how much money consumers spend, will have issues over the next 2 quarters. So watch these stocks, and I have 6 stocks for you. Amazon, which is a big e-commerce guy, and we have talked about this stock in the past. Their range is 81 to 170. Today on Friday they were 93. They will retest that low 81 when they start going below 85. Buy this stock. Start buying this stock. They don't pay any dividends. Okay, and Home Depot, which is a big company for remodeling and things like that. You can buy this stock when it goes less than 270 because they will start retesting their 52-week as well, which is 264. They're a very good dividend company. They pay an excellent dividend and they keep raising the dividend every year. Okay, so from a dividend growth point of view, it is a good stock to own. And on Friday, they were 296. Lowe's, which is very similar to Home Depot, they have a similar strategy in terms of dividend. They pay a good dividend and they keep increasing it. And their range was 170 to 238. And again, these guys will be under pressure because the housing is slowing and the consumer spending might be coming down. So I would suggest that you watch this stock, and when it starts going below 190, which is a buy zone, start accumulating it. Okay, and their dividend is pretty good, 4.2. Okay, and Nike. So Nike, over the last 52 weeks, they were 82 to 139. There was a lot of worry about China, and that had taken them down to 82. Now China is opening up, so it has come up a little bit. But I think the U.S. consumer spending will bite them, and they'll start going below 100, in the next 4 months, and that's when the mm, you start accumulating. They pay a dividend, not a very large dividend, but they do increase the dividend every year pretty good. 1.36 right now. So that's again a dividend growth stock. Okay. So the fourth company I have is SBX, which is the Starbucks. Everybody knows Starbucks. And their range has been 68 to 110. Again, their stock was very much down because of worries about, um, China, and also worries about, how are they managing cost, that type of thing. They seem to have, come around. The China opening is helping them. So their stock is pretty close to the high 111. And, their revenue will not be hit that much compared to other consumer discretionary stock because people like drinking coffee. And so the buy zone for them is not too far from where they are today. When they're less than 90, that's when you buy that stock. And they pay a decent dividend, and they also increase the dividend every year, by a nice amount. Okay, so Target. So you all know Target very well. They're a big box retailer, and they're all over the country. They are right now towards the low end of their 52-week range. 137 is the low end, and right now 166. And again, Target will have some issues in the next 2 quarters because consumer spending will keep going down. They will disappoint some earnings, and the market will punish them, so they'll start going below 150, and that's when you start accumulating. Okay, and they pay pretty good dividend, 4.32, and they keep increasing them. So 6 stock. So in summary, watch these 3 sectors and watch these 18 stocks, and you'll have pretty good opportunities with these 18 stocks in the next 4 to 6 months. Okay. And once you build that portfolio, once you go into 2024 and 25, as the economy starts improving and as the interest rate starts moderating, these stocks will do very good. And you will have, returns of more than 20%, maybe 40%. And in addition to that, you'll be getting good dividend. Okay. So that will be a good, foundation for your portfolio. All right. And that's it for this week. Okay. So a couple of changes. I'll be coming every other week. So it'll be 4th weekly video. And so the next video will be the March 12th. And as always, please subscribe to my channel. And thank you for watching my video. All right. Okay, so we will end this presentation. Okay.